JBlog, 23rd of January 2011. Today I'll start out looking at gold. I'd been talking about gold for a while now. In previous blog I'd been talking about the technical divergence, non-confirmation of the indicators. Here's the RSI, and here is the MACD, and here's the stochastic. Stochastic is not that obvious. Here is TRIX, and everything basically pointed to this thing running out of steam, and of course it did. And it is now down to 1340, possibly a very sloppy head and shoulders. I wouldn't really call this a head and shoulders formation, but definitely now in a bit of a downtrend here. Has broken the upper trend line and is now working its way towards the lower trend line. Not that that's an issue, but this lower trend line has of course been in place for quite a long time going back in history, and if it were to break through that, then that would be a bit of a problem. So I imagine gold should probably go down to 1280, 1290 or so. I had sold gold short a couple of weeks ago, and I sold some gold stocks that I believed were overvalued. Things were getting crazy. Everybody was talking about gold, which is usually at the time that there is no money to be made anymore in it. So keep a close eye on this. Silver has been following, roughly the same thing. Of course, silver has had the major run-up this year, and it has dropped a little bit as well. The other thing that continues to go the other way is the gold-silver exchange index. How many ounces of silver does it take to buy an ounce of gold? That has of course been dropping rapidly since the middle of August, and now this downtrend, this channel, very clean channel here, has been broken, which could spell a few problems. Silver has a tendency to go faster than gold, and then of course it can also go down fast. Very, very volatile metal. Oil is showing a similar weakness here, a non-confirmation. Even though oil was making higher highs, RSI did not confirm those higher highs, so RSI was making lower highs, even though price was making higher highs. And similar on the MACD side, even stochastics did not reach the same highs here. So again, there's a potential weakness in oil. We'll see where that goes. Natural gas continues to go up, and we'll see how that goes. This is the time of year that natural gas usually makes a low in January and then makes a high in March. It's a little bit higher than I wanted it, which is unfortunate because I sold out of quite a bit of it when it was at the bottom, and I thought it would go lower. Gasoline is also on the trend line. That could go down. That could be good news for consumers, because of course what they don't spend on gasoline, they will spend on other goods. Looking at gold in euros, always a telling tale. It is now just riding on top of the 200 day moving average, and if it drips below that, then that of course is quite a bit of weakness that we should be concerned about. The US dollar has not been performing according to what I thought it would. It has once again gone down. Perhaps it'll find some support in this area. Maybe this trend line was a bit too steep. The VIX is showing a little bit of nervousness right here, a little more than about a week ago, but nothing that would in any way indicate that the market actually thinks that there's trouble out there. Copper has potentially broken a trend line, but the trend line is not very clean. to start out with. It does show a little bit of weakness in terms of the RSI here. So another technical non-confirmation. Going over to the New York Composite. The composite, of course, broke its trend line back in, when was that, August, September? Actually, sorry, in November. This is a 6-month chart. And then popped up again, but never did go on top of the trend line. It's been skirting the bottom of this trend line since then, so that there's some potential weakness there. But nothing else indicating any kind of weakness quite yet. The RSI confirms the higher highs. The MACDs confirm higher highs. The OBV is strong, so it continues to go up. The market is unfazed. S&P 500, same thing. The market is still in a very strong uptrend at this point. There's no indication that this is going to let up anytime soon. Even though the stochastic has broken down a little bit, the S&P is actually a little bit weaker than the composite. The Wilshire 5000, full of 5,000 stocks, very, very broad, showing a little bit of weakness here, and perhaps startings of a downtrend, but until that is confirmed, no point to jump at it. The Dow Jones very strong, continues to be very strong. The transportation average starting to break down here, which goes coincide with the Baltic Dry Index, which is the price that shippers charge, and that is starting to make new lows. Basically, there's no money to be made for shippers, at least for sea shippers at this point. In transporting goods, there is either an oversupply or people are simply not willing to pay the high prices, so that's interesting. Nasdaq potentially hit by Apple news of Steve having some health issues, and the Russell 2000 also showing some weakness. So this is potentially something to be worried about here. The weaker stocks will fail before the strong stocks fail, simply because they're weaker, and therefore they're more likely to fail first. But the mid cap is still showing very strong, and of course another one that is showing very strong is the bullish percentage index, which right now says that 87% of stocks out of the S&P 500 have bullish chart patterns at this point. So the market is clearly not worried about anything in particular. Let me switch over here. Oops, PE ratio. So going back to the PE ratio, the S&P 500's PE ratio is still very high at 2350. At the beginning of the year, we were told, and that's 2010, we were told that the market is not really overpriced, that it's actually fairly priced, because all of these companies would come up with fantastic earnings, and that would bring the S&P 500's PE ratio back into the 14 range, which is still a bit high, but because realistically, when you look here, the sustainable rallies always start from below 10. That's when you have long-term, nice long-term strong rallies. And we are clearly not there. Going back over to the TED spread, bankers are not worried about what's on each other's balance sheet at this point. They continue to charge each other very low interest rates, and the Baltic Dry Index that I was talking about continues to go down. These are shipping charges for sea shipments. So the costs are going over there, and of course the bears say that's because nobody's shipping things anymore, and the bulls are saying that that's because there's an oversupply of shipping capacity at this point. It could be either, I suppose. But of course, seeing that I'm currently on the bear side of things, that's where I find myself. Um, then I was looking through some coal stocks because of course coal is energy, um, where the majority of industrial energy is gained. And coal stocks, interestingly enough, this is a very common stock on the coal side. All of them seem to look this way. The last 2 weeks have not been kind to coal. Now that might partially be related to Australia, or it might actually be related to um, China not buying as much coal as they used to. This one is a little bit stronger. Here ANR, this is very weak. There was a top blowout here and it's pulling back at this point, back to potential trend line. So looking through these coal charts, there's definitely some weakness to be found there. So does this mean that the end is near? I don't know. Definitely some weakness in the commodities, potentially going forward, simply because commodities were getting too expensive. I'll definitely keep a very close eye on that. That's all I have for today. Not that much really happening. It could be going one way or it could be going the other way. It really depends. Is the Fed going to continue injecting money? Are the world governments continuing to inject money? The world governments are amazingly indebted, have become amazingly indebted since 2007, and definitely propping up private industry all over the place, not just the United States, but everywhere across the world. And sooner or later, the price for that will have to be paid. But for the time being, the market seems to be happy with all the extra cash it is getting, and it is driving up the market. That's what happens. People buying stocks drive up prices, and it has nothing to do with the underlying economic situation, which is just as grim as it was before. I don't really see anything fundamental having improved, but the market has detached itself from the underlying economy, and it just continues going up, which is, of course, painful for those of us who are on the bearish side. Anyways, that's all I have for today. All the best, good luck, and make lots of money next week.